Hello, thanks for joining me and my good friend Pepperstone's senior market strategist, Michael Brown, for our weekly chat about all things financial markets in the hope that we can bring a dose of value as well as giving an unfiltered view of what's been going on across financial markets in the last few days. Good afternoon, Michael. You certainly had a busy few days, haven't you?
Yes, indeed. Very good afternoon, Jimmy. Good afternoon. Hello to all our listeners as well. Another busy week after a busy week after a busy week after a busy week. The roller coaster ride continues. Headline whiplash is not getting any easier. And all eyes on the geopolitical situation still, which is very much dominating the narrative for markets, the narrative for central bankers, and really will determine where the economy goes next at the end of the day.
Indeed, and we're coming to the end of the month and also the end of the first quarter of 2026, and it almost
Indeed.
feels like a year.
Well, Jonathan Ferro on Bloomberg said the other day the longest first quarter ever, and I think everyone in markets would fully agree with that. It was the start of Q1 when Trump went into Venezuela, and that feels like it was about a decade ago at this point.
I thought that was last year.
It feels like last year, but there we are.
Anyway.
Doesn't time fly when you're having fun?
Joy. Anyway, let's get the risk warning out of the way and then we can get cracking onto the content.
Indeed.
We've also got a question as well from a listener and a viewer, so we'll deal with that as well.
And if anyone has any questions, throw them in the comments and we'll get to them
try and answer them
next week. Yeah.
You may not like the answer, but at least
we'll give you one.
We'll give you an answer.
Exactly.
Anyway, this content is for general information purposes only and does not take into account your personal circumstances or financial objectives. Nothing in this material is or should be considered to be financial, investment, or other advice on which reliance should be placed. The material has not been prepared in accordance with legal requirements designed to promote the independence of investment research. Okay, so broad overview. It's been pretty much more of the same. Oil and gas prices spinning around all over the place. I think the risks for the global economy are intensifying further.
Mm-hmm.
I think the effects of it are underpriced. So we're going to talk about that in some detail. I think markets are underestimating the longer term impact of these disruptions, let alone the fact that oil and gas prices are likely to remain at elevated levels. Obviously, there's talks of ceasefire. I don't think it's going to be much more than that because I don't know what you think, Michael, but I can't see anyone agreeing to Iran's demands and I can't see Iran agreeing to the US demands. So this weekend could be interesting.
Yes. Well, we'll get into that in a second. I won't jump in that.
No, absolutely. So obviously we'll talk about the effects of the attacks on Qatar's infrastructure, and I think that's being underestimated by the market. So we'll look at central banks, the UK economy. Obviously the OECD's come out this morning and downgraded UK growth quite significantly due to its exposure to energy prices. We'll look back at this week's numbers from Next and Kingfisher, both very good. Have a brief look at the FedEx numbers and also last week's results from Wetherspoon, which were not very good. Well, it wasn't so much they weren't very good. They downgraded their profit expectations on the basis of higher energy costs. What a surprise. I wish, who could have seen that one coming?
Yeah, exactly.
And then we'll go to the week ahead, US payrolls and PMIs, as well as the flash reading of EU CPI. And I think that will give us the first indication of the impact that these surges in oil and gas prices, energy prices, will have had on European headline inflation and the likelihood of an ECB policy response, which then leads us back to obviously the OECD, who suggested that the ECB should hike rates, but the Bank of England shouldn't. Try and square that circle. Okay, so
where do we start with all that lot?
Where do we start? FTSE 100's gone below 10,000. It has found support at the 200-day moving average and its 38.2 fib retracement from the lows last year to this year's peak. So I think the bigger question I have, Michael, given the fact that we've seen a big sell-off in the wake of our podcast last week, because the sell-off came at the end of last week.
Yes, it did.
Pretty much after we'd finished recording and all of Friday. We've seen a modest rebound. What's your take from here?
Yeah. I mean, again, without wanting to sit on the fence too much, it depends on what happens in the Middle East, frankly. I think probably my biggest takeaway from the last sort of 4 or 5 days, and just to timestamp this, we're recording on Thursday afternoon, so anything that happens after about 2:30 today is, going to be dependent on then and will be out of date. Quite. Having said that, I think the big signal from this week is that the US, at face value at least, seem to be looking at some sort of de-escalation. Obviously, we had these threats from President Trump over the weekend to potentially strike Iranian power plants and energy infrastructure. Those threats were then postponed on Monday for a period of 5 days. Trump was talking about how there are talks and negotiations going on with Iran. He said many times throughout the week, Iran wants to make a deal. The Iranians have been ranging between we're not engaged in any talks at all through to the demands that the US have said have put forward are unacceptable, and here are our demands. They are miles apart, as you might expect. I'm not sure how much credence there is in any of this reporting, to be honest with you. I think the market has been somewhat calmer and steadier this week. If you look at equities in particular, you mentioned, I think kind of the general pattern over the last month or so has really been we've gained ground on a Monday, basically as participants have come in and realized the weekend wasn't as bad as we thought it might be. And then we've just sold off pretty much every day of the week afterwards. This week's been a little bit different because we gained ground on the Monday. And then if you look at the S&P, if you look at European equities, we've just kind of gone nowhere since. And it feels like the market's got a little bit of headline fatigue coming in. And I think we're really now getting to the point where participants want to see some sort of concrete steps towards de-escalation before they take that risk-on rally a little bit further. And of course, there is still a lot of skepticism in the market as to talks going on. Can a ceasefire be agreed? The longer run damage to the global economy that you alluded to, which is also just keeping people on the sidelines, I think.
Yeah, and I think it's underpriced as well, because to me, I just think that any solution that leaves Iran with a say in how traffic navigates the Straits of Hormuz is simply unsustainable.
Indeed. I agree it's underpriced, but I think it's also perhaps impossible to price because, if you think about the longer run situation where, as you say, you may have a situation where Iran have control of the Strait of Hormuz in some way, shape or form. You may have a prolonged period of time of energy disruption, particularly in terms of natural gas and other things that come out of the Gulf. The problem is, if you want to position for that through, let's say, an equity short, you can't really do that at this moment in time because every market participant knows that the second a war is over or ceasefire agreed headline crosses your Bloomberg terminal, the S&P is going 5 to 10% higher, probably in the blink of an eye. So I agree, I think the market is underpricing that risk, but from a tactical basis, if you want to trade it, why would you not just wait for a better level to get in at on that bearish view once the sort of conflict risk is out?
Yeah, I mean, I wasn't suggesting you try and implement a tactical short. That would be
No,
not
no,
something
but I
that I
think
would
that's
even
why
think about doing.
I
would
think that's
work
why
at it.
markets are struggling to
Yeah,
price that in.
I would work at it from the other point of view and look to buy a potential dip as opposed to selling a rally. Because as you quite rightly said, if you're headline chasing, you really need to do it on the basis of a dip rather than a rally, because when you get a rally, it'll be a face-ripping rally and it will completely wipe you out.
And we got a teaser of that on Monday. The S&P rallied 2.5% in the blink of an eye, and European stocks did similar on the back of that Truth Social post postponing the strike or the planned strikes on Iranian energy infrastructure. But of course, that just leaves us with another deadline because that 5-day postponement expires tomorrow, Friday. What happens then? I don't know what happens then is the honest answer, but that uncertainty is again in market participants' minds. We don't know how that situation is going to evolve. We could be looking at dramatic escalation over the weekend, or we could be looking at, a much more positive outcome. We simply do not know how this is going to shake out.
Or we may not get any escalation at all in the short term, but certainly I think in terms of US troops being transported to the area, they're there in the event that there will be an escalation. And I think the timing of that will be entirely in the hands of the president. So I think there'll be an awful lot more shouting and screaming. You're not going to get them there and then immediately go in. You might as well just telegraph what you're going to do. You keep your enemy guessing. But in terms of the underpricing bit, what I was talking about earlier was the attack on the Qatari infrastructure, because while all the focus has been on oil, natural gas has a number of byproducts that essentially are very essential to the global supply chain. Helium, for a start, has to come through there. Sulfur, urea, which is used in fertilizer, and then you've got naphtha, ammonia, ethylene. None of this disruption is priced in yet. And I think that's why inflation is going to be an awful lot higher and stay a lot higher over the course of the next 12 to 24 months, as either this infrastructure gets rebuilt or, and that will take years potentially, or another method of basically getting these products out and into the supply chain takes place.
And of course, the other thing is not only will it take a prolonged period of time to rebuild and repair a lot of this infrastructure, you also need the war to end first before you can even start those repairs.
Well, yeah.
Because there's no point, for example, if you own a natural gas plant or an LNG terminal, there's no point repairing it now if there's the potential for either the repairs to be interrupted by a missile strike or a missile to hit it as soon as you finish the job. You're just going to have to start again. So, it is potentially a prolonged disruption that we're looking at. And again, I think, there are so many moving parts to this that this is where I think you're seeing a bit of a disconnect coming through between commodities and equities. Because if you look at commodities, if you particularly look out the curve to, 6-12-month forward pricing or futures pricing, on crude, for example, we have seen a continued rally in those contracts. That is reflective of the market expecting supply disruptions to persist for a prolonged period of time. Whereas the equity market seems to be trading a much more binary, is there a war going on or is there not a war going on? And that is basically determining whether we are risk on or risk off on any given day at any given hour.
Essentially, they can't price it.
Yeah. Exactly. And, you've got so many headlines, you've got a torrent of news flow. And, one of the things I've been doing almost every day is, you sort of sit down at the end of the day or the start of the next morning and you tot up what you could reasonably call escalatory or negative headlines on one side of a bit of paper, and you throw down the negative or headlines on the other side of the paper. And basically they net off and amount to roughly the same thing. There is very, very little kind of overall signal that you can extract from what's going on.
I think one signal that has been, I think, to a certain extent ignored has been the move higher in bond yields. I think markets have been fairly relaxed about them thus far, particularly here in the UK. But I'm looking at UK markets, and obviously we had the UK CPI numbers out this week. But of course, they come with the enormous caveat that they're breakout of hostilities or kinetic
action.
Activity.
Yes.
Kinetic activity. I mean, 27th of February, the 10-year UK gilt was at 4.3%. It went above 5% this week, and it's now at 4.93%.
And we haven't been north of 5% since before. Well, it was 2008, wasn't it? I think the last time we were up at that sort of level.
It was pre-financial crisis, basically. And I think, that's a signal. It's a signal that markets are not only concerned about the fact that we're not going to get rate cuts, but it's also the UK's ability to react in terms of economic policy when it comes to potentially cutting spending.
Well,
because
exactly that.
It's, this current administration doesn't have a reflex to cut spending. Its reflex is to increase taxes. Now, you don't increase taxes into the teeth of a supply shock.
No, and and the other thing is they're already talking about increasing spending as well, because Rachel Reeves has been running around talking about support for energy bills and all the rest of it.
Which is madness.
Well, it is, and Chancellor, if you're listening, maybe hold off on that one for a while until we have an idea what the impact's actually going to be, because we're 27 days in, and the energy price cap does not change until July. Of course, the summer people use less electricity and gas anyway. Let's just leave that one be. But I do think, again, you see, whether it be on geopolitics or whether it be on any other driver, it's another event of many that we've had over the last year or two, where we have had a global sell-off in government bonds and gilts have borne the brunt of it. And the reason for that is because the UK is coming into a shock and in this supply shock, of course, or a shock of any kind, with one of, if not the weakest fiscal backdrops across the G7, and a government who we know have no desire to get a grip on things, and the market is punishing them for that. And if you actually work it out, the OBR, when they did their March forecast round, that was conditioned, the £22 billion worth of headroom that Reeves had against the fiscal rules, that was conditioned on the 10-year yield being at 4.5%. Well, the 10-year yield's now at 5%. So back of the envelope maths, that's 8 billion quid of headroom that's been eroded simply in the last month because the market has moved. This is basically going to become a third year of this doom loop that we seem to be stuck in.
And I think if the Chancellor really wants to help people, she could cut the VAT on fuel prices.
Yeah, and that would be a very easy solution. Could do it overnight.
We talked about it last week, didn't we?
Yeah, and if you do the maths, or overall revenue take would not be that different because fuel prices have gone so much higher.
Yeah. And that's that's the point that I was making. You're getting increased VAT receipts because fuel prices are higher. If you want to cushion that blow,
Yeah,
the bond markets probably won't punish you
no.
in the same way as they would if you basically spend an extra £500 million on basically bailing out consumers for higher energy bills because of your own stupid policies.
Yeah, exactly that. Yeah, I mean, again, I think it is far too early to be talking about any sort of support measures when we don't know exactly the magnitude of the shock and how that's going to feed through. You mentioned the inflation data that we had this week. It is a bit stale, so I'm not entirely sure there's much value in looking at it. But, inflation unchanged at 3% at a headline level, services down to 4.3%, which was the lowest since March of 2022. But
Core was higher.
Core was higher. And in any case, we know that headline inflation is probably going to 3.5%, maybe just above 3.5% in March, and maybe higher still as the year progresses, depending on what happens with energy prices.
Which sort of feeds into what the OECD was warning about this morning when they updated their growth forecasts for not only the UK, but the global economy as a whole. I mean, there was some good points in that inflation report, and that was the slowdowns in headline PPI. But, you might as well throw that out the window.
Well, I was going to say, again, that was good news in February, and then now it's not for obvious reasons. And I think this is the problem with all the data that we've had in terms of the pre-war economic figures. They just can't really give us any sort of signal about where we're likely to head moving forwards. And I know we'll talk about it later on, but I think next week's Eurozone inflation data is going to be very important because it's going to be the first developed market March inflation print. Not only is it key for telling us, what might happen in the Eurozone in terms of monetary policy or whatever, but also globally, because participants are going to look at that and basically extrapolate whatever happens in Europe to every other economy.
Okay, we had a question, because seeing as we're on the subject of
Yes.
gilt markets, about the political consequences from the May the 6th local council elections and the gilt market. Now, I don't think there's any doubt at the moment that the current Labour administration is going to get an absolute kicking.
And arguably a worse kicking than the pretty severe kicking we were already expecting on the back of what's going on with affordability, etc.
Now, the problem with that is obviously, will that prompt a leadership challenge from the usual suspects? I mean, we already know from PMQs this week that Starmer's prime minister in name only. Miliband is pulling the strings behind his back, given his comments that, I can't do anything because Ed's in charge of that. You're prime minister, for crying out loud.
You're the boss.
Crying out loud. What is wrong with you? I mean, that's just such a cop-out.
Yeah.
So there may not be a leadership challenge because he's prime minister in name only. You've got basically the marionette, the puppeteer in the background pulling the strings.
I still think there will be.
You still think there will be, but obviously, how much more upside is there in gilt yields now?
Well, I think there could potentially still be a lot of upside in gilt yields because, you've had this, and yes, it's been a significant sell-off, 70 odd basis points compared to where we were pre-conflict. But that's 70 odd basis points within the constraints of the current fiscal rules and without any increase in political uncertainty. So if you then move to a world where we're still dealing with higher inflation expectations, we're still dealing with higher energy prices, we are talking already about potential government support on energy prices, and then you throw into the mix, firstly, political uncertainty through a Labour leadership challenge, easy for me to say, and secondly, the fiscal uncertainty that would be caused by what's almost certain to be a much more left-wing chancellor. And Ed Miliband's name has been mentioned as a potential chancellor, and also a much looser set of fiscal rules. I mean, I wouldn't want to try and pick a top in terms of where the 10 or the 30-year gilt yield could trade in that sort of an environment, because you're almost talking about a perfect storm at that point.
Just when you think things can't get any worse.
I think they could get a lot worse, worryingly.
Well, there's a bigger issue for me here. You remember at the end of last year when we were talking about a record amount of bond issuance for 2026? How's that going to work now?
There'll always be a buyer for gilts. It just depends what the price and the yield is and whether the UK is able to afford the yield that investors demand.
Well, they can't afford the yield at the moment. I mean, it's making up pretty much most of the public sector borrowing requirement.
Yeah, exactly. And I think that that's only going to get worse for what, the interest expense is only going to go higher, not even forgetting any of what we've just discussed, but we've got to refinance what we've got at the moment at much higher yields on the back of the recent sell-off. But I do. My assumption is there is still going to be some degree of political maneuvering after the local elections. Could that be delayed if we are still in a scenario of conflict? Potentially. But I do think we are still in a world where, Keir Starmer is ultimately on his last legs as Prime Minister, and, one or two more issues, whether that be at the ballot box or somewhere else, then I don't think anyone's going to have too many qualms about finally sticking the proverbial knife in.
Yeah, but then again, you've got to then basically decide, do you really want to basically take the flak for what's about to hit the UK economy?
Well, this is it, isn't it?
You've got to have, I don't know, you must be a narcissist
Yeah.
in the extreme.
Yeah.
Narcissist, yeah. Or, I just can't think of a scenario where I would want that.
No, nor can I, but we're not politicians.
We're not narcissists.
And if you're, a politician who's always wanted the top job and available, an opening comes up to get the top job, you're probably not going to turn it down, are you?
Anyway.
That's why you work in finance and they work in Westminster.
Because I understand this stuff. And I think that's one of the concerns I have. We've got a whole host of people who basically don't understand basic economics. They don't understand how supply chains work. They don't understand how uniquely vulnerable the UK economy is. I just tweeted, I read this when it came out a few years ago.
That's Ed Conway's,
right?
yeah.
Conway's book, right? I think it should be required reading for every Muppet politician currently in Parliament, because even then I thought to myself, we are royally screwed because of what we've done to our industrial base over the course of the past 20 or 30 years. The blame is equally distributed on this. From the Labour government of the early 2000s to the Tory and Lib Dem administrations between 2010 and 2024. And this current Labour administration, if you thought the last lot were financially illiterate, Christ almighty, hold my beer.
Well, yeah, exactly that.
So, I make no apologies for this book. It's not every day's cup of tea, but it's a good non-fiction book. And John Stepek also recommends it at Bloomberg.
Good book.
It's a really good book, and it gives you a really deep understanding of,
what's going on, essentially.
Global supply chains and how everything stitches together.
Yeah.
Anyway.
No, absolutely.
Let's move away from UK markets. So hopefully that answered your question, Simon. If it doesn't, just drop a line in the comments to Michael or myself, and we'll try and address it further. But ultimately, the local elections, I don't think, are really going to make that much difference. It doesn't change the narrative. Labour are going to get kicking, and pressure is likely to remain on gilt prices, which would mean that we could see further upward pressure on yields.
Indeed.
Okay, let's move on to a little bit of because I think it's worth mentioning Unilever again. As in the news, it confirmed that it was in talks with McCormick, the US foods business, for the sale of Marmite and its Coleman's mustard brand. As you would expect, the markets didn't really like it that much, judging by the share price reaction.
Yeah.
And I'm struggling to understand the rationale behind it, because they've been selling off businesses pretty much since 2017 of Unilever, because they want to focus on personal health care, beauty, that sort of thing. Because for whatever reasons, they somehow think that it will deliver better value. Well, in that time, they've sold their spreads business, they've sold their teas business, they've spun off the Magnum ice cream business, and the share price hasn't moved from where it was in 2017. So much for unlocking value. What's your strategy here, Unilever management? Because I tell you what, I'm damned if I know what it is.
Well, I don't know what it is either. I don't think they're unlocking value. It seems like they're getting rid of value, to be completely honest, at this point. And, I think quite clearly the precedent is not great because, as you said, they've done 3 or 4 of these spin-offs recently, and the share price has gone absolutely nowhere on the back of it. I also think the timing is not great because
It's rubbish.
they have,
they're not going to get a good price for it.
well, I think there's two issues. One is they've just gone through a massive restructuring, having got rid of Magnum, and now they want to basically try and restructure the company again. And secondly, look at the broader market environment, for goodness sake. European equities are 10, 15% off the peaks. You've got a huge amount of geopolitical uncertainty going on. Right now is not the time to be doing significant M&A. And I think actually this is bucking a major trend, which has been a big slowdown in deal making, because basically the environment is too uncertain to know exactly what's going on. It is not an environment in which you can do these sort of just on any level. I don't understand it. If someone does understand it, please do enlighten us, because I'm really struggling to see the rationale for it at any point, let alone right now.
Yeah, I mean, I think if I look at, say, for example, GSK, when they spun off Haleon back in 2022, if you look at the Haleon share price now, it was spun off, I think, at 330p per share. It's now 360p per share. So it spun off, and it hasn't really offered much to its shareholders since being spun off. So
Yeah.
I'm not convinced that Unilever focusing on personal brand and away from foods is the silver bullet that they think it will be.
No, I would agree. And, this is the sort of thing, we've spoken about spin-offs numerous times on this podcast. Primark or ABF are looking at the Primark
exactly.
business, and BP are trying to streamline as well. They're the two big ones at the moment. And there's always kind of two arguments. One is, is it better for a company to have a niche and stick to it? Or is it better for them to be more diversified across different product lines, and you have diversified revenue streams, and, you can have outperformance in some and underperformance in others, and it all sort of nets off? Well, I think evidence in Unilever's case would actually point to the latter being the better scenario for the company, but they don't seem to want to go down that path for whatever reason they've decided.
No, I mean, ITV is another one.
Of course. Yeah, ITV. Yeah, that's a good point.
Yeah, because obviously there's been talk about splitting advertising and studios, but studios is the money earner. I mean, advertising is going to take a hit. So why on earth would you then look at spinning off your studios, which is likely going to be your money earner anyway?
Yeah. But again...
And we've got the World Cup coming up, so actually there could be
Yes.
a little bit of a boost to the ITV share price, assuming obviously the World Cup still takes place. I don't think Iran will be going.
I think it's probably quite safe to say that they're not going to be going. But yeah, I'd be interested to see what happens with that Unilever one, because, well, I can't see any logic for it myself. And from what I've read in terms of other commentary, I don't think anyone's a particularly big fan of the idea right now.
I think it's a terrible idea. I mean, can you imagine the Americans making Marmite?
Well, they've made a mess of everything they've tried to make recently.
Oh, they made a mess of Cadbury's.
I will say this as someone
and they made a mess of Terry's.
I will say this as someone who absolutely cannot stand Marmite, so I don't really have a vested interest in this one.
Yeah, I mean, people say I'm a bit like Marmite. You either love me or you hate me.
Well, I'll leave it to you.
There's certainly a lot of haters out there anyway, but I can live with that. Anyway, let's move on. Kingfisher and Next reported this week, and I got to say the numbers were fairly decent on both counts.
Yes.
Kingfisher, I mean, the share price popped significantly higher, but it's now pretty much back on the lows. I'm a little bit flummoxed as to the reaction, but I'm guessing, and I don't know whether you'll agree with me on this or not, the numbers are rearview mirror stuff, and I think people are worried about what's likely to come over the course of the summer.
Yeah,
I think particularly when it comes to B&Q, Screwfix and what have you. French business is still a dog. But B&Q and Screwfix did very, very well.
I think you're exactly and absolutely right. It's all well and good saying that the business did very well in the year ending 1st of January, but the year ending 31st of January was a very different world to the one that we're now living in. And of course, if we are moving to a situation where you are going to have higher inflation, you are going to have, potentially consumers pulling back on their discretionary spending to a degree, then that's not a sort of environment where a B&Q or Kingfisher are likely to perform particularly well. Yeah, I think the the equity market reaction makes complete sense simply because, we do not know what's going to happen moving forwards. Yes, it's fine. I've got comments from the chief exec in front of me here saying, we have no operations in the region. Well, that's not really the issue here, mate. The issue
No,
is
it's not.
what impact it's going to have on your customers and whether they are able to spend in your stores. And that is
And
very
supply
much up,
chain.
and supply chains. And both of those are very much up in the air at this moment in time.
I mean, there's some shortages of building materials at the moment being reported coming into the UK, which is likely to slow down house building.
Well, I'm not sure house building can slow anymore. It would just stop, wouldn't it, at this point?
No, but I think in terms of loft conversions and stuff like that,
I see what you mean. Right.
the insulation that's used for,
Right.
they're not going to. Apparently it's run out, or it's getting very close to have run out, and one of the key conduits for that is the disruption to supply chains. Looking back at Kingfisher, they expected to see adjusted profit before tax to come in slightly above this year's, but free cash flow to come in slightly lower. And here's another one, and it's another bugbear of mine.
I knew this was coming.
Share buyback of 300 million. Okay, so Kingfisher, since 2021, has completed £1.2 billion worth in share buybacks. The share price is currently 286p. And in 2021, it was around about 315.
Yeah,
so
hasn't
where's the
made much
shareholder
difference,
value
has it?
there?
Yeah, well, this comes back to the point we were making previously.
Utter nonsense.
I agree. I think it's complete and utter. I was going to say something I can't say on a podcast then, but yes, that I completely agree with you. Yeah, I've got nothing else to say on that, really. I think our views on buybacks are very well known at this point. I would also question in the current environment whether a buyback is actually a wise idea, given that it's probably a better idea to actually keep a little bit more cash on your balance sheet to deal with whatever shocks the economy might be about to throw at you. But there we are.
Yeah, I think that's a very poor move on. I think they should have basically kept the cash on the balance sheet.
Yeah, exactly. And, at the end of the day, if for whatever reason they want to embark on this buyback, just announce it next quarter or in the next half yearly results when we've got a bit more clarity on what's actually going on. I don't think there's a need to rush into that right now.
Yeah, I think Next have struck the right balance today. With their full-year numbers, they recommended a final dividend of 181p per share. Group profits before tax up by 14.5%. Next full price sales were up 10.9%. They raised their pre-tax profit guidance for the next fiscal year to £1.2 billion, but they were very, very cautious about the outlook. And it was significant that they've set aside an extra £15 million in respect of related costs because of the conflict of the Middle East, but also said that with respect to supply chain disruptions, easy for me to say, and freight rates, they were going to give a further update on May the 6th when they issue their first quarter trading statement.
Yeah. And again, I think, the results were pretty good, and in classic Next fashion, they boost the guidance a little bit as well. However, again, there is a need for caution because, as with everyone, we don't know what's going to happen next. And with them being so heavily reliant on discretionary consumer spending, if we are dealing with a significant demand shock as a result, a negative demand shock as a result of higher energy prices, then there are downside risks to the company's performance. And I think it's, again, prudent what they've done in terms of the announcement this morning.
Yeah, I think the full price sales guidance for this year, for the next fiscal year, it's 4.5%. They'd already guided for that at the previous trading update. But if you look at what this year's guidance or what this number was, it was 10.8. So they've more than halved it.
Yeah.
And I think that's significant. So
I think it is. And, as they said themselves, they hope to offer more clarity in May. And I think really that's all anyone can hope for. Although the stock is up about 6% on the day.
It is, yeah. I mean, but as I say, it's also down from the record highs that we saw in the middle of the, at the beginning of November. Yeah, I think it was about mid-November. So it's still quite well off those highs. Well, I say well off those highs, not much off those highs. It's certainly, I think it's outperformed the wider market in terms of the fact that it's down, but it's not down by anywhere near as everything else.
Yeah, absolutely.
Wetherspoons, one of your favourite establishments. They've been given an absolute shoeing.
Well, clearly I'm going to have to go in and just spend a bit more, and I'll buy some Guinness in there and see if I can get Diageo into gear as well, shall I?
Yeah.
Everything is on my shoulders.
It is, mate. Pre-tax profits down 32% in the first half. 32%, £22 million. I mean, and I think the numbers really tell their own story there, don't they?
They really do. And again, it is the same old story where, the cost pressures that the business is facing are only mounting. And, it's actually understandable why the market has given it so much of a shoeing, to be completely honest, because there's not really much in there to be a particularly large fan of. I mean, yes, revenue was up, but...
But there is, though. You've said it, revenue was up. It's like for sales, up.
Costs.
Profits down.
Up.
Costs. It's costs. Essentially costs. There's nothing Wetherspoon can do about costs.
Well, and I think this is the problem, isn't it? Because, we can recognise that costs being higher are the issue for the company, but also they can't do anything about those costs. So therefore, they are kind of stuck with having to pay all of the higher national insurance costs, higher energy costs, et cetera, et cetera. It's fine. And I think Tim Martin's absolutely right to say that, this is not our choice to be paying these costs. They are being imposed upon us. But the fact is they are still being imposed upon the business, and they are still harming the profitability of the business, and the share price has to reflect that.
I mean, I would argue that given the impact on costs and given the fact the business is still managing to turn a profit is a sign that the business is very, very well run. I mean, you think about it.
It is incredibly well run, don't get me wrong.
£22 million in profits in the first half, okay, which equates to, say, for example, just assuming they make the same amount in the second half, you're talking 40-odd million pounds for the year,
Basically.
Right? Their costs are up by £60 million, 60. And then there's £7 million in energy costs on top of that.
Yeah. It's silly.
It's madness.
Yeah, it is. And, probably 50% of those costs, I think, I haven't got the figures in front of me, but about half the costs came from higher minimum wage. And that's before you consider, business rates and bills and energy costs and goodness only knows what else. And of course, all of this was before the energy price shock. So energy prices are only going to be even greater cost on the business now compared to what they reported as well.
I mean, I think they did have some visibility on that anyway, because obviously the results came out on Friday. So I think, Tim Martin's astute enough to sort of know that with natural gas prices being the main driver of inflation here, and they've almost doubled it here in Europe and the UK compared to the US, where they barely moved. And that's another misconception. This idea from so many people that there's a worldwide price for national gas. No, there bloody isn't, you morons. There is not. No. Because if there were, why is US natural gas barely moved?
Yeah, exactly. And there just is not. And anyone who says there is a worldwide price for natural gas clearly does not understand how the market works. In fact, there's not really even that much of a regional price for natural gas, if we're being completely honest, because the pipe networks are relatively limited. Yes, you've got TTF, but TTF just trades differently to UK natural gas because the networks aren't connected. But anyway, let's not turn this into a power podcast.
Oh, I wish we could. Anyway, actually, I'm glad we can't, because otherwise we get trolled endlessly, I would imagine, by
my blood pressure would go through the roof.
The economic illiterates on social media. Okay, let's move on to next week.
Yes. I've got a bone to pick with someone about this. It's Easter next week. Yes. It is a holiday shortened week next week here in the UK and in the US. If you are at the Bureau of Labour Statistics and you are listening to this podcast, please tell me which genius decided that non-farm payroll should be released on Good Friday. Who on earth is in charge of that decision? I mean, just push it back a week, for goodness sake. And just before anyone gets the wrong impression, this isn't me moaning that I have to work, although I am annoyed about that. It's also the market reaction is just going to be a mess, because you're going to have one man and his dog trading, for goodness sake. Conditions are going to be so thin that report will drop into a market that just could go absolutely anywhere, no matter what the number is. Anyway, rant over.
To be quite honest, I don't think it's really going to move the dial that much, if I'm honest. I mean, because I think the market has bigger things to worry about.
I think it could. It could.
The floor is yours.
The reason I say this is because the January jobs report was good. At a headline level, 120, 130,000 jobs added, unemployment at 4.4%. The February jobs report was poor. Employment held steady, but the economy lost 92,000 jobs last month in February. And some of that can be explained by cold weather. Some of that can be explained by strikes. You had the birth-death adjustment in there. That doesn't explain all of it. So you net those two figures together and you basically say, well, actually, over January and February, the labour market didn't really do anything. It was just kind of steady. So we come into the March report, I would argue, against a relatively delicate labour market backdrop where if you get another soft print, and I don't necessarily mean soft in terms of payrolls declining, but even, 10, 20K, for instance, I think that's going to bring to the forefront once more worries about the state of the US labour market. And in turn, that could then put the Fed in a bit of a bind because, of course, the Fed operate with a dual mandate, maximum employment and price stability. You know that the price stability side of the mandate is going to be challenged by higher energy prices, pushing inflation higher in the months ahead. The absolute last thing that the Fed want or need right now is the labour market to start weakening again, because that then challenges the employment side of the dual mandate, and the two are pulling in opposite directions. And that becomes a very, very difficult policy balancing act. Ultimately, which side do you focus on? What do you do with the Fed funds rate in reaction to that? Do you cut to try and support the labour market? Do you stay tight to try and bear down on inflation expectations? So I completely agree with you. The market does have, bigger fish to fry at this point. And if the payrolls prints are bang in line with expectations, we're not going to see a ripple, I would imagine. But I do
What is the expectation?
there isn't one yet, which is nice and helpful, which is why I didn't say.
Okay. No, that's fair enough. So I wasn't trying to catch you out because I honestly didn't know.
No. We're a bit early to get the consensus just yet. But I do think that...
Do you think February was an outlier, Michael?
Can I ask
Because if you look at the ADP reports, they've been steady pretty much across the whole last 3 to 4 months.
My gut feeling is it was. My gut feeling is that it was. There were a few one-off factors that pushed January to the upside. I mean, one of the biggest factors that pushed January to the upside was healthcare. The healthcare sector added 125,000 jobs in January, which was double the average of the last 5 years. So there's clearly something going on there.
But it was also a downside in February.
It was, which makes me think there's a few statistical quirks that need to kind of work their way through the data. Because as you say, you look at alternative indicators, the ADP data, the weekly ADP data has been pretty steady at kind of 10,000 jobs a week on a 4-week average. Jobless claims initial claims have been between 200 and 220,000 for as long as I can remember at this point. Continuing claims have barely moved.
And they did jump at the beginning of February, which is when obviously the payrolls data is taken
in the survey week.
Why it was negative. Yeah, the survey week.
Exactly that. So my gut feeling is February was a blip. It was probably a one-off. I don't think the US labour market is sort of firing on all cylinders. I think that it's still very much a kind of very slow hiring, very slow firing dynamic. But I don't think February was necessarily as bad as we thought it was at the time. But, this time next week, we'll find out. Keep a close eye on the revisions as well. If there were various statistical quirks, they may well be revised away. But I think viewing it through the lens of what the Fed are going to do is the way to look at things.
What do you make of the big jumps that we've been seeing in the prices paid components of the ISM surveys recently? I mean, is the Fed going to be concerned about them?
Not yet. I think everyone knows inflation is going higher in the next 3 months. What I think the Fed will be very closely watching is inflation expectations. Are they moving higher as well? Are consumers expecting that inflation is going to stay high in 5 years' time? That's something and market-based inflation expectations as well. I think the fact that prices paid, indices are moving higher, it's not a great sign, but it's also not a surprise.
I'm always confused by the idea, do consumers think that inflation is going to be higher in 5 years' time? That doesn't even occur to me as a consumer. Who the hell are they asking?
I don't know.
Because it certainly isn't me. I mean, I can't even predict GDP out for 6 months, let alone inflation for 5 years.
Well, it does make me chuckle. So we put a lot of weight on it. Central bankers put a lot of weight on it. But you are right. I mean, we are paid to do this sort of thing and we get it wrong more often than not, as do most other economists on the street. And what's happening? Is the ONS going up to a man in the street with a clipboard and saying, could you tell us where CPI is going to be in 5 years' time? I don't know how they do the survey.
I've got this mental image in my head of these old clipboard jockeys in shopping centres going, excuse me, sir, and where do you think inflation is going to be in 5 years' time? What?
Yeah, well, what's inflation will be the first question, wouldn't it? So, I don't know how that one works, but there we are.
We've also got UK final fourth quarter GDP. Again, no surprises here. I think we can probably park that because I think the interest now is what Q1 GDP is going to be like, and we're probably not going to get the first iteration of that until the end of April, beginning of May.
Correct.
So,
yeah, although we did have the PMI number, you mentioned them earlier, the PMI data this week, which was, composite metrics falling pretty much everywhere. Again, unsurprising based on what's going on.
I think we could start to see a mortgage approval slowdown, maybe not in next week's numbers, but going forward, given the number of mortgage deals that have been pulled off the market in the last few weeks. And ultimately, I think if you're looking to move right now, and given the current economic uncertainty, I think you might park that for a bit.
Yep, I think you're absolutely on the money with that one. I mean, you look at 2 and 5 year swap rates. I think the 2-year swap is up about 70 basis points compared to where it was this time last month, which is a huge move. And as you say, the degree of uncertainty is such that unless you absolutely need to move, I just think people won't be pulling the trigger yet.
There's another factor as well. 5-year mortgage deals are expiring this year. And look at where rates were in 2021.
Yeah, you
so
mean
it's
the one
going to
struck
be
in 2021? Yeah, exactly.
Yeah, you're going to find that if you've had a mortgage at that rate, you're going to be in for a very nasty shock when you start to refinance.
Yeah,
Over the course of the next few months.
I mean, yeah, where were we then? The high ones, low twos, I would guess.
I would imagine we weren't even that far, because when did the Bank of England start raising rates?
That would have been December 2021.
Right. Okay. Well, in that case,
so but yeah, you may even have been lower than that. Yeah.
Yeah, you may be 1 or 2. In terms of the 2-year and the 5-year.
And if you go from 1 to 4.5, 5,
yeah,
probably.
I mean,
that's punchy.
It is punchy. It's punchy. I mean, the 2 years have rolled off already, but now you've got the 5-year rolling off.
Yeah, but I think that will be something to keep a very close eye on. But all of this is too early to show up in the mortgage data we get next week, because that's for February, isn't it?
Okay, let's talk UK, EU flash CPI for March. So this will be the first indication on the macro front of the effect that the fighting in the Middle East will have had on inflation in Europe, but more broadly, what we can expect to see going forward for UK and pretty much everywhere else.
Indeed. And really the only question is, how high is it going to go? Headline inflation came in at 1.9% in February. It's going to be a big chunk higher than that this time around. I was looking at Bloomberg earlier on. The consensus is currently for 2.5%. Could it be higher? Potentially. We know what's driving it. We know why it's gone higher. The ECB, I think, and I might have got this wrong, I think they put in 2.6% as their 2026 forecast based on the March economic projections. The real question is going to be, what do the ECB do on the back of this? Because we've had a lot of comments from policymakers this week. The word vigilance has been started to be used once again, which people of a certain vintage will associate with Mr. Trichet. And
strong vigilance.
Well, we haven't had the strong yet.
When you
Indeed. And that
2011.
Indeed. And it's funny you mentioned that, and I'll come back to that in a second, because that was always the sort of code word that a hike is on its way and that policy tightening could be on the horizon. And the ECB, they did hike in 2011, just before the sovereign debt crisis. They did hike in 2008, just before the great financial crisis. Are they going to hike in 2026 before the great energy crisis? And it would be a huge policy mistake, I would imagine.
Yet the OECD seem to think that they will, but they also think that the Bank of England won't.
And I can square that circle for you that you asked me to square earlier on. And I think the very simple reason for that is the ECB's deposit rate is at 2%. The ECB's neutral rate is at 2%. So the ECB are running a neutral monetary policy stance coming into the crisis. The Bank of England bank rate is at 3.75%. The UK's neutral rate is at 3%. So the Bank of England are coming into this with a restrictive policy stance. What that means in something resembling English is that the UK's stance of policy is tighter than that in the Eurozone. And in order to continue to put pressure down on inflation expectations, you would want to be running a restrictive stance. The Bank of England are already there, so they don't need to hike rates to deliver that restriction. The ECB are not there. So if they want to deliver that restriction, there's only one way to do it, and that is to put rates up.
Very well explained. And yet EU inflation is back at target and UK inflation is not.
Indeed. And again, I will stress that I do not think that rate hikes should be even talked about, to be completely honest,
I
in
think
any G10 central bank.
I think you're right. I think you're right. I think the best thing the Bank of England can do, and I think it was a point highlighted quite well by Megan Green in a speech earlier this week, is to do nothing, because she thinks that energy prices are likely to stabilise at a much higher level.
Yeah, and ultimately, I think there is just too much uncertainty to have any conviction behind a policy move at this moment in time. The landscape could and probably will, and we hope it will be different and much more peaceful at the end of April when these policy decisions have to be made, compared to the end of March where we are now. I think it is perhaps a little bit premature to be considering and talking openly about the idea of rate hikes at this juncture.
No, I would agree with you on that point. I would certainly agree with you there, mate. Let's finish up with Nike.
Mm.
They are reporting their third quarter numbers on the 31st of March, and for some reason I haven't added it to my week ahead, so let me just pull the chart up. So we're caught out by not being prepared there. And their shares, I mean, their last set of numbers, there was a fairly negative market reaction to them. They did rebound from 7-month lows at the big start of the year, but they've since slipped back to more multi-year lows. And I think they're just above their Liberation Day lows. Let me just double check that.
Yeah, they have had a pretty torrid time of things recently, haven't
Yeah.
they, to be completely honest. And again, I think, almost what we were saying for Kingfisher, what we were saying for Next, very much applies to Nike as well. How are consumers likely to be impacted by what's going on in the Middle East? We don't know, is the very short answer to that. But, the Q2 data, the Q3 numbers that they're going to report reflect a world that probably doesn't exist anymore. So I don't think there's going to be much by way of signal in that. It'll be interesting to see what guidance they offer and the degree of conviction they have around that guidance. But again, it's a consumer discretionary stock in an environment where the consumer might have a pretty torrid 6 months ahead.
Yeah. Let's talk about Raspberry Pi. I think that's probably about the UK's sole contribution to the AI story.
No, that's wrong.
All right, go on then.
Holdings.
Yeah, but they're listed in the US.
I know.
I'm talking UK listings here.
Right, fine. I was going to say, because they announced a deal this week that they're going to start making their own chips for the first time.
Yeah,
and
no,
selling them for the first
I
time.
did see that. So yeah,
But you're right, they are listed in the US, so I'll
Yeah.
give you that one.
I mean, they caught a massive bid earlier this year, did Raspberry Pi, on the back of reports that the company's mini computers were capable of running a popular AI chatbot known as OpenClaw. Which can be used to interact with messaging apps like WhatsApp. But that hasn't really lasted. It was sort of the UK's answer to a meme stock rally.
Yeah, and
And
then it disappeared again.
Yes, disappeared again. Their sales, adjusted EBITDA for 2025 would be ahead of market consensus and not less than $45 million, which is a 20% increase in 2024. And like other companies in this space, there's been a massive increase in the costs of price of DRAM.
Yeah, and supply constraints as well, which is going to be a big issue because it's all well and good for the company to have higher demand, and obviously that's what a company wants to see, but the question is, are they able to fulfill and meet that demand? And not only were there shortages of memory before the geopolitical situation flared up, the issues with helium and goodness only knows whatever else in terms of supply out to the Middle East are only going to make those issues even worse. So yeah, I think a degree of caution is probably going to be needed when looking at the figures. We had, as you said, that brief spell in February where all looked fine and dandy, and now it doesn't look quite so fine or dandy.
I think the thing confuses me about this, Michael, is the fact that, while it's being reflected in the share price of, say, somebody like Raspberry Pi, which is a very small player, these higher costs are not really being reflected in companies like Nvidia. They're not being reflected in, say, for example, expectations about companies like Amazon. And essentially, they are all subject to the same supply chain constraints.
Yeah.
And I think this is what goes to my earlier point. Markets are underpricing the risks of higher costs. And
that
impacts
is something,
on margins.
Indeed. And that's a very nice circular way to bring us right around to the start. And I think that's something that we're going to have to pay very, very close attention to as we move through the weeks and months ahead. Obviously, we hope that the conflict in the Middle East comes to an end in very short order, but the effects and the spillover after impacts of that conflict are probably going to be felt for a fair time to come.
And I think on that note, I think we can probably tie this particular podcast up. So
Indeed. Good fun as
That's
always,
it.
mate.
Always a pleasure. Until same time, same place next week. Otherwise, have a great weekend, everybody, and we'll talk to you all next week.
See you later.